In the last 24 hours, new real estate data revealed that inventory in one famous California city has skyrocketed by 70% year over year, triggering a panic among sellers. To understand why this is happening, today, November 24th, 2025, we need to look at the perfect storm that has made landfall in California. For years, we heard that homes only go up, but 2025 has shattered that myth. Three major factors have collided this month to accelerate this collapse. First, the insurance exodus has reached a breaking point. Major insurers like State Farm and Allstate didn't just pause new policies, they have begun aggressively non-renewing tens of thousands of existing ones in fire-prone areas, effectively rendering homes uninsurable and unsellable. Second, the tech correction is far from over. Layoffs in Silicon Valley have persisted through Q3 of 2025, drying up the buyer pool for million-dollar starter homes. And finally, interest rates have remained stubbornly higher than predicted, trapping sellers who are now forced to cut prices to escape their mortgages. Just this week, reports confirmed that California's outbound migration is still outpacing arrivals, with moving trucks booked solid for Texas, Arizona, and Nevada. But unlike the exodus of 2020, which was about lifestyle, the 2025 exodus is about survival. People are leaving because they simply cannot afford to stay in cities, where value is evaporating while costs rise. Today, we are exposing the specific towns where this collapse is most violent. We have to start with the city that real estate data is now calling ground zero for the 2025 correction: Oakland. If you look at the numbers released for October and November 2025, the situation here is dire. Oakland is currently seeing one of the fastest price decelerations in the entire country. Reports indicate that median home prices in some Oakland neighborhoods are down nearly 25% from their 2022 peaks. This isn't a softening. It is a full-blown valuation reset. The catalyst here is a brutal combination of public safety concerns and the tech pullback. In 2025, we are seeing active inventory in Oakland spike by over 40% year over year. Homes that would have incited bidding wars 2 years ago are now sitting on the market for 60, 90, sometimes 120 days. Sellers are slashing prices by $100,000 or more just to get an offer. The spillover demand from San Francisco has evaporated, as remote workers choose safer, more affordable metros outside the Bay Area entirely. If you are holding property in West Oakland or near downtown, the equity cushion you thought you had may have already vanished. Just across the bay, San Francisco is facing its own reckoning, but with a different flavor. The narrative that San Francisco always bounces back is being tested like never before in late 2025. While the total price drop percentage might not be as steep as Oakland's yet, the luxury condo market here is in absolute freefall. We are seeing median prices for condos down significantly, with inventory swelling to levels we haven't seen in a decade. The specific issue in 2025 is the doom loop of commercial real estate impacting residential values. As downtown office vacancies remain historically high, the support businesses, restaurants, shops, services are closing, making neighborhoods less desirable. Tech workers, who are no longer tethered to an office 5 days a week, are asking, why pay $1.2 million for a one-bedroom apartment? The answer, increasingly, is that they won't. This month, we've seen listings in Soma and the financial district languish with 0 offers. The premium for living in the city center has turned into a discount, and savvy investors are staying on the sidelines, predicting that the bottom is still months away. Now, let's move to the high desert, where a completely different bubble has burst. Joshua Tree and the surrounding Yucca Valley are currently the poster child for the short-term rental apocalypse of 2025. During the pandemic, everyone and their cousin bought a desert shack to turn it into an Airbnb goldmine. But today, that gold rush is over, and the hangover is brutal. Data from late 2025 shows that the number of short-term rentals in this area has skyrocketed, saturating the market to a point of no return. Occupancy rates have plummeted, leaving investors with empty homes and expensive mortgages. The result? A panic sell event. Inventory in Joshua Tree has exploded from under 200 listings a few years ago to over 700 active listings today. Prices are dropping as desperate investors try to offload their liabilities before they go bankrupt. We are seeing price cuts on nearly every listing, and homes that were flipped for $600,000 are struggling to sell for $450,000. It is a classic case of supply overwhelming demand, and for the high desert, the party is officially over. Heading into the Central Valley, Stockton is once again flashing the same red warning lights we saw in 2008. In November 2025, Stockton is experiencing a dangerous surge in inventory, up 70% year over year in some reports. This isn't just about people moving. This is about affordability hitting a brick wall. Stockton surged in price because it was the affordable alternative to the Bay Area. But with interest rates staying high, local buyers are tapped out. What's terrifying about Stockton right now is the rise in distressed properties. We are beginning to see the early signs of foreclosure activity ticking up. Homeowners who bought at the peak in 2022 with adjustable rates or strained budgets are finding themselves underwater as prices dip. The median days on market has stretched to over 50 days, and the competition has vanished. When you see inventory nearly double in a single year, that is a supply shock that crashes prices. For Stockton, the correction is looking more and more like a crash every single day. Down in Southern California, the glamorous oasis of Palm Springs is facing a harsh reality check. This market is heavily driven by second homes and retirees, two groups that are pulling back hard in late 2025. The condo market, in particular, is taking a beating. Recent stats show median condo prices dropping by nearly 3.5% year over year, while inventory piles up. Why is this happening? It's the cost of carry crisis. HOA fees have skyrocketed. Insurance premiums in the valley have doubled or tripled. And cooling measures on short-term rentals have made owning a vacation home here significantly more expensive. But retirees are looking at their bills and deciding to sell, flooding the market with condos that no one wants to buy at current rates. We are seeing price reductions on nearly half of all active listings in the Coachella Valley. The days of bidding wars over a mid-century modern remodel are gone. Now, it's a buyer's market. But the buyers are nowhere to be found. Finally, we need to talk about the hidden crash happening in California's most expensive zip codes, places like Pacific Palisades and the fire zones of the Sierra foothills. This isn't driven by a lack of demand. It's driven by the sudden disappearance of insurance. In 2025, after major insurers like State Farm exited the market, homeowners in these high fire risk areas are finding their property values slashed overnight. Imagine trying to sell a $3 million home when the new buyer cannot get a standard insurance policy and is forced onto the California Fair Plan, which offers less coverage for 4 times the cost. We've seen reports of home values in affected areas dropping by 16% simply because the insurance contingency kills every deal. This is the silent crash. It doesn't always show up in the headline median price immediately, but it's happening in the failed escrows and the massive price reductions required to entice cash buyers who can self-insure. If you live in a very high fire hazard severity zone, your home equity is currently under siege. So, what does this map of declining cities tell us about the future of 2026? It tells us that the California real estate market is fracturing. We are no longer looking at a monolithic boom. We are looking at localized busts that are spreading like a contagion. The implications for you are massive. If you are a buyer, patience is your best weapon. The inventory buildup we are seeing in places like Stockton and Joshua Tree is not going to clear in a month. It will take huge price cuts to move these homes, meaning the bottom is likely not in yet. For sellers, the window of naming your price is nailed shut. If you are in one of these vulnerable cities, Oakland, San Francisco, the high desert, you need to look at the 2025 comps, not the 2022 fantasies. And for the rest of the country, watch closely. California often leads the national trends. The insurance crisis starting here is already moving to Florida and Colorado. The affordability wall hit here first, but it's coming for every hot market. The Great Correction is a warning shot to every over-leveraged market in America. The California gold rush is in reverse, and these 10 cities are just the beginning. The data doesn't lie. Prices are down, inventory is up, and the exit doors are crowded. If you found this update crucial, hit that like button and subscribe. We'll be tracking the next city to fall next week. Don't get caught holding the bag.